Good afternoon, everybody. Thank you so much for joining us today. Whilst we wait for a couple more people to join, I will just play a little video in the background. Wonderful. So good afternoon. Welcome. Thank you so much for joining us today. My name is Laura Nieves. I'm proudly responsible for Astor Realty Capital's investor relations and operations. So today we are presenting our exciting new investment opportunity. It is a 64-unit mixed-use condo development in Jersey City, New Jersey. I'm excited that we have a full house today of our friends and family investors, and we hope that you will find this presentation informative and educational. We will have the opportunity to address any questions you may have during at the end of the presentation. So if you have some questions, feel free to drop them into the chat option, which is below, and we will address towards the end of the presentation. So firstly, I would like to say a few words about Astor Realty Capital. We are a private equity firm, and we currently participate in over $1.5 billion of assets. Our existing portfolio consists of assets in New York City, Chicago, and Florida. We're headquartered in New York, and we have operations in Miami and Phoenix. The Astor team, along with Joe Berko and Michael Kareen, consists of experienced real estate professionals, and we are fully integrated with our sister company, which is Berko and Associates. Berko is a commercial real estate advisory firm. So on that note, today I'm excited to introduce Joe Berko. Joe Berko is the founder and president of Berko and Associates and the co-founder of Astor Realty Capital, along with Michael Kareen. Joe, over the course of his 25-year career, has structured, raised, syndicated, and sold and acquired over $3 billion in commercial real estate deals. Joe is often quoted in various industry publications and regularly appears on professional expert panels. He is the recipient of a number of awards, including Globe's Top Producer and CoStar's Power Broker. And Joe has been appointed by 2 governors of New York to serve as an advisor on the New York State Real Estate Board, which he served for 9 years. So on that note, I'm excited to say over to you, Joe.
Hi, Laura. Thank you. Hi, everyone. Good to see you. Thank you for joining. We never take it for granted. It's a Tuesday. It's a Tuesday afternoon, and it's kind of like raining and going pretty hard over here. And I hope that the storms are not going to have any effect on our presentation. We're excited to go into our newest transaction in Jersey City, New Jersey, to build 61 high-end condo units. We're building about 100,000 square feet building, 61 condo units, over 4,400 square feet of retail. There's also an existing loft building, which is part of that acquisition and part of that assemblage, which we're going to actually renovate and bring up to standards and sell back to the seller. Total budget for this project is $44.2 million. We're going to be using about $30 million of debt, $14 million of equity, and we're expecting to sell for a total of $68 million. Astor's portion of this investment and this transaction is going to be 40% or $5.5 million. And we're anticipating an overall return of 84.7 to our investors over the course of 3.5 years. We're looking to close this transaction. I don't know if you guys have heard it, but it's pretty wild out here in Miami right now. It's a pretty big storm happening. We're looking to close late October, and we had left about $1 million to our friends and family club. We have about 4.5 out of the $5.5 million already committed, and so we're expecting those units to go quickly. In terms of timeline, as I mentioned, we're looking at around 36 to 42 months. And we're at the pre-construction phase, which essentially had started. We're already in the planning phase and talking to the city. This is an as of right transaction. So we're saying between 9 to 12 months. The reality is it's most likely going to be shorter than this, but it's nice to be conservative. Construction will take us around 15 to 18 months, and then marketing and sales somewhere between 9 months to a year. In terms of budget, we're, as I mentioned, looking at a $44.2 million budget composed out of $14.1 million of equity and $30 million of debt. We are not going to take you through all those numbers. However, we will send it over to you so you'll have a chance to review it. And I'm happy to take you individually through it and go through each and every one of our components. Of course, we have a full due diligence that anyone who's invested or interested in investing can go through and understand the project very thoroughly. There's been a lot of work that has been done. Our projected sales are averaged on $875 per square foot. We're going to take a look later at the market of new construction for condominiums in the Jersey City area. $875 a square foot, in our view, and based on all the comparables, is low. Okay, it's somewhat low. I would say probably between 10 to 15% lower than other comparables. We like this number. We feel safe with that number. And so from the new structure that we're looking to sell, the net sellable is 68,000, almost 69,000 square feet of residential component. Average unit will go for just below $1 million for total sale price of $60 million gross. As I mentioned, we have a condo, commercial condo, 4,400 square feet of commercial condo. We underwrote it as an exit of a 6 cap or $600 per square foot, which will generate 2.7 million. The existing loft building, it's interesting structure. It's in fact the owner of the property, the seller of the property, has been using this loft building as its headquarters. It's a family that's been there for more than 2 generations, been operating out of this loft building. And part of the transactions, they have an option to acquire it from us after we do some renovations and converting the building, which is now used as somewhat as offices, into residential lofts and retail at the bottom. Essentially, we're selling it to them at a sweetheart deal. Now, they have an option. Should they choose not to exercise the option, we're going to make a lot more money off of it. As it is, as I mentioned, it's a sweetheart deal, and that's part of the transaction. So the family will be buying it back from us for $3.5 million. We're planning to have 38 parking spaces that will trade for about 40,000 a unit for about $1,520,000. If we sum up this column from the residential, brand new residential condos, the commercial condo, the existing loft building, and the parking spaces, we're looking at around $68 million or $67.9 million. We're looking at around just shy of $4 million in total sales cost. Provide for us about $64 million, just about, and repay the debt, repay our first position mortgage, which will leave us with a gross sales of just shy of $34 million, repay our investors our equity at $14.1 million, and leave us with a net sales for distribution of $19.7 million. As intended, we always leave a small portion of the amount that we raise to our friends and family. It's been a growing club. It's been a successful club. And it's been a very steady club. We started with just friends and family, as we call it, and it's now been growing, and more friends are bringing others. And so we're enjoying that growth. Essentially, the return on investment to this essential piece or portion is going to be about $1.1 million. The way we structure it is we always say an investor places its capital. We do a minimum of 8% hurdle. So every year that the investor had actually placed its capital, we look for at least an 8% minimum. And after an 8%, we start participating in the profits of the investors. And at that point, we're starting to take our success fee. So computing 3.5 years on the amount invested leaves us just about $300,000, which is what we call the minimal hurdle, the preferred, the 8% per year. The remaining promotable amount, which is the amount minus the 8%, is about $807,000. We do participate in that portion, which nets us, Astor, about $201,000, and leave the investors with $904,000. Essentially computing the 904 over the invested amount of $1,066,000 will generate for us 84.7 or 24.2 over the course of 3.5 years. I do want to mention that each and every investor that we bring participate in fees. Those fees, it's 5%. It's that information here. And of course, we have it all described throughout our prospectus. But essentially, each investor participates in 5% of their fees. And we use this to keep the lights on, to pay salaries, and to get the operation going for the next 3.5 years as we monitor the progress of the project and so on. Here we have an example of what's $100,000 invested, although a minimum investment amount is $35,000. We're looking at this example as $100,000 invested. Over the course of 42 months, an investor is going to generate 84,740, I'm sorry. And then we'll return back the 100,000 plus the projected returns, total of 184,000. And this is how we're computing our return to the investors. This is again net of fees. And as I mentioned earlier, our commitment amount to this project, $5.5 million, out of which 4.5 has already been raised. And the amount that we're left for the Friends and Family Club is $1 million, just a little bit over $1 million. A little bit about our developing partner, which is really a big part of how we do the operation. We always make sure that the investors that we bring, that the investment that we participate in is essentially a group that has the kind of experience we're looking for, deep pockets, certainly experience in the local markets. And I can say that that on this particular deal, we found some of the most active developers in that submarket of New Jersey. So a little bit about them. We have 3 groups here that are participating in managing the project on the day-to-day. Norca's Property is essentially 2 partners, David and Esri, which have been in operation for quite many years, but have formed a joint venture partnership about 7 years ago. Their focus, as we'll see throughout this presentation, is solely in the New Jersey city in the immediate area. So they've done a multiple project, they've done it very, very successfully. Now, why is that important to us? Because they are familiar with the bureaucracies, they're familiar with the city ordinances, they know who they need to speak with, they know what they need to do in order to get a project done. The second partner on this transaction, there's two GPs, right? Two co-sponsors, is the Goldstone Group. The Goldstone Group is a group that's been investing for well over 20 years. We'll talk about them in length. And Mirage Construction. Mirage Construction is a general contractor, a GC. It's a family-owned, also several generation, run by Joseph and Marisa, husband and wife, wonderful individuals. And they're also placing money into this project, which is something that gives us a lot of comfort. So overall, we're talking about individuals with a lot of experience, real money into the project, and a lot of experience in the providing construction for the immediate project. I'm not going to go over this page. We'll send it over to you. You can take a look at this, but this is information about Norcas Group, the first group that I've mentioned, which is going to deal with the day-to-day development. Essentially, this is a portfolio of the project that they've built together. They built more projects outside of the Norcas Group, but under this brand, as you can see, all their projects are in New Jersey, the majority of which are actually located a block away, a couple blocks away. You can see some visuals of some of their existing properties. The Goldstone Group, again, as I mentioned, have been around for well over 20 years. They have a master portfolio that is composed of multifamily, industrial, and office. They are physically located in New Jersey, very close to the site itself, and investing in majority of markets between Pennsylvania, Philadelphia, New Jersey, various markets, Connecticut, parts of New York, and so on. Portfolio masses, as I mentioned, just shy of about $1 billion, very deep pockets, great reputation. We know those guys for many, many years, probably over 16 years. And so we're very happy to participate and to form this venture. Mirage Construction, which is also a very important component, is not, again, as I mentioned, not only a GC or general contractor who deals with building of the structure itself, but they're also putting capital into the project, which gives us the comfort level, because we always say those with skin in the game tend to stay in the game. A little bit about the property itself. At the moment, you know, as I mentioned, this is going to be a luxury or mid-luxury, if you will, or sometimes I refer to as affordable luxury. It's going to be a variety of 2 bedrooms, 3 bedrooms, a little bit of 4 bedrooms, and 1 bedrooms as well. With each one represents a certain segment of the overall units that will offer to the market when the project is complete. The existing 4-story building will be 3 keyed elevator lofts. Each one will be a full floor through lofts over retail. And so that makes us overall the 64 units. The building itself, the new section of the building, that it will have a fitness center, a game room, and a package room, storage unit, of course, parking spaces, roof deck, and so on. So it's going to be a very exciting building. Looking at Jersey City, as I mentioned earlier, we've taken the stand of being a little bit more conservative than what we're seeing on the comparable sites. I think we looked at around 7 different condo buildings in the immediate vicinity. Some of them have been around, like, for example, 61 Grand was being built in 2005, a very unique building, was averaging today around $1,000 per square foot, as compared to our subject site, which we're averaging at $875, a lot more conservative. And if you look around, you sort of like see older projects and older product that's being offered to the market and are doing significantly better. You know, some maybe have not been built up to certain standards, and so they're averaging $850 a square foot, which is quite close to what we're actually underwriting ours. So when we're saying that we're expecting our investors to make a return of around 84%, we sort of like really underwriting and hoping that the market will maintain where it is. And so we'll all come out of this investment happier with better returns. Location, a little bit about Jersey City. It's considered to be the hottest market in New Jersey, and then some are considering to be like the 5th most attractive markets to millennials. Obviously, it has a great presence, one of the best views in the world overlooking Manhattan skyline. It's much more affordable for young families. It's an area that's been steadily growing. It's about 300,000 population, 290,000 population, and a steady growth over the course of the last 10 years of about 15% a year, which basically means that about 4,000 plus individuals are coming to Jersey City to call their home on an annualized basis. And so the demand is certainly there. There's a lot that can be said about it. The proximity to Manhattan makes a very big difference. 41% of folks that live in Jersey City, in fact, use the transit. We are essentially transit oriented with very easy access, as you can see, from where we are straight into Wall Street, and a very easy access to Midtown and centers of employment. We're effectively 1 block away and 2 stops essentially from the Wall Street area. So it makes it a very, very quick and easy commute. A little bit about the market in Jersey City. Essentially, you know, if you look at year over year, and I don't think this is probably the fairest example, but we can see the year over year, Q2 of 2020 versus Q2 of 2021, we're seeing a jump of about 169% in sales. Not surprisingly, we all know what happened in Q2 of 2020, but certainly it shows you that the market is very much alive. There's a very strong demand. You know, housing days on the market, you know, typically stays for less than 2 months, 45 days, 47 days. And so we're looking at a very solid market. Again, if we compare this location, which translates to quick access to employment centers, right? Obviously, Manhattan's been the center of gravity in this location. If we're talking about the environment itself, which is fun to be, young, great restaurants, great nightlife, and very, very affordable accommodations, Jersey City will always maintain a very solid presence. It's even a little bit less expensive or a little bit more affordable than Hoboken, which is the neighborhood right next door. About us a little bit. We have a few individuals on the call with us that are hearing about us for the first time. So why Astor? Couple of key points. Preservation of capital. Our main and chief concern is preservation of capital. We place money together with our investors. We've been doing it for many years between Michael Corrine and myself. We've been running real estate, commercial real estate investments for a little bit over 60 years as a combined experience. We have a lot of background in doing what we do, and I think that's extremely important. We're conservative in our approach to investments. And as Laura said earlier, we have about $1.5 billion of participation, of real estate participation that Astor is taking part of. Our projects, you know, going through a black swan event, 2020, COVID-19, our portfolio is doing well. In many instances, we're actually doing better than expected. Ongoing asset management. We always take the stand that our partners will do what we inspect, not what we expect. We have an onboard asset management team run by Michael Corrine and a few other individuals in our office that monitor where the money goes, where time, budget, making sure that things are as they're supposed to be. When we're negotiating a contract with an investment partner, we always maintain the right to step in if something doesn't go according to plan, if there's any negligence. And so we're sort of like, you know, on top of everything that's going on a daily basis, weekly basis, and we have reporting to you, the investors, and those of us on the call that have been seeing our reporting, I think, are very satisfied with what they're saying. We're able to generate above market return. I think that a lot to do with the fact that we choose good projects. We have, between both companies, Berko and Associates and Astor Realty Capital, we have over a group of 15 originators. We go through anywhere from 30 to 40, in some months even more than 40 transactions that we go on a consistent basis. We have tremendous access to information that is not available out on the street, and we're able to pick and choose the proper project and the right projects for us. And to be quite frank, 95, maybe more than 95% of the projects that we see, we say no to for a variety of reasons. Lack of experience. We don't believe the numbers. We don't think that the cost of construction might be sufficient. We don't think that the individual that is asking us to participate might have the kind of capital that we're looking for, and so on and so forth. There's many different reasons, but 95% of the projects that we go through, and we go through a lot, our analysts are, burning the midnight oil quite often to go through a lot of transactions. On 95%, we simply decline. And those that we choose are actually, the proof is in the pudding. You look at our portfolio and thank God, knock on wood, and fingers crossed and kept on going really good. Alignment of interest, as I said earlier, my capital, Michael's capital, our family, direct family members, our childhood friends, we're all putting money together. We have the same exposure as each and every one of our investors, and we wouldn't have it any other way. As I said before, those with skin in the game stay in the game. Our money has the exact same risk as anybody else. And the personal approach, we are still nimble. We are accessible. Laura is accessible. Everybody have my cell phone number. Our investors have Laura's cell phone number. We have a portal. All the information goes in there. We're transparent, and we'll always maintain the very same approach. I'm not going to bore you with too much details, but there's a lot more that you can read about myself and my careers. We've had all kind of nominations and all kind of big moments throughout our career. I've been around for about 25 years. Michael's been around for 35 years in the business as an investment banker. And that's what we do. It's the only thing we do, and that's what we love to do. And, we are very passionate about that. Some of our projects, as you can see here, some of the renderings were invested heavily into Brooklyn. This project is doing great for us. We're actually outperforming Manhattan. We're on time, on budget. We're looking very carefully at what's happening into the Manhattan market. And we're doing a mark to market on this particular project, and we're still generating a double-digit return to our investors. A new project that we're just pretty much at the very last beat of raising is a ground-up Manhattan project, 50-story building that we're doing with a very large developer. We're very excited about that one. Chicago, we're over 72% sold in a place called the West Loop, which is kind of like the Brooklyn area of Chicago. We have other projects in Brooklyn that are doing really well. And we're investing in 9 submarkets between Westchester, a project that we've just entered this week, actually, parts of Manhattan, downtown, parts of Brooklyn, Florida, Tampa, Chicago, as I've mentioned, and so on. We're managing over $94 million. The number is needs to be updated a little bit. There's over $94 million of capital under management at this point in time. And as we mentioned, our portfolio is certainly growing. Before we sum up, and just want to take one last moment to sort of summarize what we have here. So we have a great investment opportunity, great team, highly experienced and super focused geographically where they're building. We're happy to participate with them. We've looked at a number of opportunities from this particular group. And I'm happy that we chose this particular project. I think it's a great project. I love the location. In a transit-oriented location that is very central, to be 1 block away from where the PATH train that leads you directly to Wall Street makes an impact. We underwrote the project conservatively, and we're still able to show very, very nice returns. This particular example talks about $100,000 investment. However, you're able to participate with a lower amount, where we still ask that the minimum amount will be $35,000 and some change. However, a $100,000 investment will generate for our investors projected $84,740 over the course of 42 months or 3.5 years. And so we're looking at 84.7 over the duration of time. And not that we're going to put it in our presentation, we certainly hope and we certainly believe that the project will be doing better than we expect. Thank you for your interest, and I'm happy to get on a call with each and everyone who has any questions. We can take the time, we can go through the presentation and address any concern or any question you might have. As I mentioned, we're closing in late October, which means we need commitments now, fairly quickly now, in the next coming days and the next week. And I hope to see you among our investors. Laura, back to you.
Thank you so much, Joe. Thank you so much for that overview. That was absolutely fantastic. And I'm sure everybody feels the same way. If you wouldn't mind just staying on for a couple more minutes, Joe, we do have a couple of questions from the audience.
Sure.
To anyone who would like to obviously leave, you will get the presentation in your email following this Zoom. So Joe, we just have a question from one of our listeners. Can you discuss the amount of parking spots in comparison to the unit count, that there is less parking spots in comparison to units?
Sure. So Jersey City essentially has its own ordinances of what is the minimum amount of parking spaces. It's not a driver that causes essentially it's not a money generator, and so essentially you want to have a reasonable amount of parking spots. So in this particular project, the ratio is just the ratio that is right for the immediate location. The requirement is, I believe, a little bit less than 38 spots, so we're okay with that. Keep in mind that this is a transit-oriented development. As I mentioned before, we're a block away from the PATH train. And the majority of the individuals that are coming to be in Jersey City are essentially doing it because of the proximity, because of the ease of access to the PATH train. And so as far as city ordinances, 38 parking spots works for us, and that's essentially what we're delivering.
Wonderful. Thank you, Joe. And another question is, after the heavy rains that we experienced here in New York the last few weeks ago, is the developer taking in any accountabilities for that in the near future, potential flooding or rains?
Yes, absolutely. First of all, it's worth mentioning, people think about Jersey City as sort of like the edge of the Hudson River. We're a little bit further up. We're at the downtown Jersey City section, so we're a little bit, but somewhat removed away from where the river is. And although it's entirely considered as part of a, if you might want to call it the flood line, there are certain ordinances that are taken into account and certain elevation that is very, very important. Some of the older buildings don't have that, and we'll find it to be challenging. However, new buildings are taking that into account. I'm not going to go technically into exactly what sort of elevation we're given here in order to maintain that the building is not affected, but certainly the right amount of elevation is being given for this project. Anybody who's interested about the flood and what exactly we're taking into this, I can give a full write-up and share with you. Okay, so there's something that's very, very technical.
Wonderful. Thank you, Joe. And one more question, if you wouldn't mind just going into the Astor promote a little bit more, if you just spend a minute on breaking that down, just to clarify the Astor promote.
Sure. Let me go back to that page. Okay, so I believe it's this page. Let me try. Yeah, this is the page. Okay, so our promote structure essentially creates a waterfall where we return preferred of 8% on an annualized basis to our investors on the amount invested. So $100,000 over the course of 3.5 years essentially will generate a certain amount of return. And the first 8% goes to our investors. And the reason we're doing it in such a way, because we said there is a certain minimum acceptable to our investors before we can actually start putting our fees into the returns that the investor is making. We create sort of like an accelerated segment. We call that segment the preferred return. So on every investor, before Astor starts taking its fees, gets an 8% on an annualized basis. Any amount above 8%, we take a success fee of 25%. So essentially above 8%, the investors and us are splitting 75% to the investors, 25% for Astor for the work that it's done for the last 3.5 years. In this particular presentation, our projected is the return overall to the investors of an investment of $1,066,981 will generate $1,105,962,000. Taking out the 8% preferred return, removing that amount from the total return, okay, will leave $807,207 that we call the promotable profit, okay, and which we take 25%, which is our success fee. In this case, it's $201,802, and it leaves the investors essentially $904,000 for distribution.
Wonderful. Thank you, Joe. We're loving the questions, guys. Thank you so much for sending them in. We will go on. I'll do a couple more. Joe, if there is an overrun on the project or any delays, would the investors be required to add any more funds or a capital call?
Okay, very great. So what do we do with cost overrun? We always negotiate that in the event of a cost overrun, and sometimes it happens, first of all, to sort of like maintain that we have enough capital, there's always an amount over reserved, both in the hard cost and the soft cost that we keep. And let me see if I can go through here. So we call those reserves contingencies. Okay, and so we have additional capital to offset any sort of cost overrun, change orders, and things of that nature. And then we negotiate that in the event that there is an additional amount of capital needed, okay, we only act in a form of a loan. So there's no dilution to the amount of capital that gets to be invested. So essentially, if we end the project and there's been some sort of a change order that goes above and beyond the contingency amount, and we feel that this is a legitimate change order that is required, then we'll participate, but we'll bring in fresh capital, and that will have its own loan segment, or what we call sometimes as a corporate loan. It's also very important to mention that the individuals that we work with, giving us a contract, so the GC, the general contractor, giving us a gross maximum price guarantee. So once we sign a contract with our developer, essentially he's guaranteeing that the budget will remain the budget. If there's any changes that is not caused by us because of fluctuation in maybe change to material cost or change to labor or anything else, essentially the entity that suffers that is in fact the general contractor, the GC. So we're doing our best to control that under no circumstances, if there's a need for some additional capital that is caused by maybe a force majeure or something along those lines, we don't call back our investors, but we actually bring this money as a small loan to be paid as a priority before return of capital. Okay, I see the question here. Do we get the returns at the end of the 3.5 years prior, or do we get it along the way? So this is a condo project. And as a condo project, you essentially, you start the project, you at one point, when you file with the Attorney General, you're allowed to start marketing. So as we look at the timeline here, that'll be easier to explain. The marketing and sale phase essentially starts somewhere around midway through construction. Our marketing team will start advertising and will start getting individuals buying into the future complete project. Got to sign contract, and eventually we'll wait for the project to complete. In reality, We have 61 units from the brand new project to sell in reality. And what we're seeing right now, for example, in one of our Brooklyn projects and our Chicago projects, where might be around 60, 70%, 80% of the project committed under contract. Units are effectively sold. And we're waiting for the point in time where the building will be complete and we'll be able to offer the buyers the option to enter into the building. So eventually at that point, the first to get paid is obviously the bank, and every leftover amount starts getting distributed to the investors. We always maintain a reserve to make sure that the contracts are getting paid and so on. So we always employ that mechanism. And so sometime between let's say month 36 and month 42, we're going to start doing distributions until the last unit is effectively sold, but there's no distributions along the way. We do have other projects where we have distributions along the way. It's a different structure. I'm happy to discuss this offline with anyone, but this is a different presentation. But on this particular project, we're investing directly into equity. And so we wait until we covered enough of the sales to cover the amount that we have to pay for the bank. Any amount over the reserves will start getting distributed until, as I mentioned, the last unit is sold and we're all paid off.
Wonderful, Joe. Thank you so much. That has been very valuable, and thank you for addressing all of those questions. If anybody else has any other questions, please, you have my email. You all, majority of you will have contact with me. Please reach out to me. I will get your questions answered immediately by the expert Joe or Michael Kareen. So once for joining us this afternoon, it's been a pleasure hosting you. We really appreciate you taking the time, and we hope that you found this investment just as exciting as we find it. You will all receive the full presentation in your email following the end of this Zoom. And as Joe said, any questions at all, please feel free to reach us. We're here for you at all times. Thank you again, everybody, and wishing you a blessed evening.